Okay, let's dive into this. Welcome to The Explainer. Today, we're breaking down what is absolutely shaping up to be the most highly anticipated and honestly fiercely debated financial event of our generation. We're talking about the massive SpaceX IPO. We're going to take a completely objective look, peering right into the company's S1 perspectives, just to see what's actually going on under the hood of Elon Musk's tech empire before it officially hits the public markets. Right off the bat, we have to talk about the unprecedented scale of this thing. I mean, the company is aiming for 1.75 to 2 trillion. Yes, trillion with a T, dollar valuation. And they're looking to raise a staggering $75 billion. That makes it by far the largest initial public offering in human history, totally dwarfing the old records set by Saudi Aramco. It's a massive number, right? And it demands serious scrutiny. This is exactly why we need to separate the sci-fi hype from the cold, hard financial facts. Because by June 12, 2026, this won't just be a rocket company going public. It's this sprawling ecosystem that's absorbing space infrastructure, telecom, and artificial intelligence all under one roof. So here's our roadmap for today's explainer. First, the biggest IPO ever. Second, the Starlink profit engine. Third, the AI cash black hole. Fourth, the ultimate controlled company. And finally, number 5, the mega IPO trap. Let's start right in with Section 1, the biggest IPO ever, setting the stage. Moving right along to Section 2, the Starlink profit engine, which is really the core of the bull case here. Now, what's really interesting about this is the stark contrast in these numbers. If we want to understand why institutional investors are actually okay with a $2 trillion valuation, we've got to look at what's generating verifiable, hard revenue right now, and that's Starlink. With $11.4 billion in revenue and a $4.4 billion operating profit in 2025, Starlink is just an absolute cash machine. They've got over 10 million subscribers. But look closely at how heavily that Starlink profit is actively subsidizing the massive losses in the other divisions. It's genuinely wild. The traditional space launch segment lost over $600 million, and the newly absorbed XAI division lost a staggering $6.4 billion. Basically, the internet service is actively paying for both the rockets and this massive AI build-out. And all of this massive revenue ties into an incredibly powerful market mechanic known as passive index flow. Here's how it works. If SpaceX goes public at this gargantuan size, it's almost immediately going to join major indices like the NASDAQ 100. And when that happens, passive index funds are legally required by their own prospectuses to buy the stock so they can mirror the index. Analysts are estimating this can trigger anywhere from $500 billion to $700 billion of forced automatic buying from the $19 trillion passive index market. Literally, it creates this perpetual bid that artificially props up the stock price, completely regardless of the underlying fundamentals. Which brings us to the very popular Elon Corp theory. The bull case here heavily relies on how all these distinct businesses cross-pollinate to build this completely unparalleled competitive moat. For instance, we're seeing a joint chip facility called TerraAb down in Texas. SpaceX is buying hundreds of millions of dollars worth of Tesla megapacks for their AI data centers. Starlink is gearing up to provide the connectivity backbone for Tesla's new robo-taxis. So why does all this matter? Because they are sharing engineers and supply chains, right? Making this entire ecosystem incredibly vertically integrated in a way literally no other company on Earth can even attempt to match. All right, flip in the script to Section 3, the AI cash black hole and how it's sucking in the profits. Let's open up that S1 fine print and shift our narrative over to the bear case. Because look, for all the crazy media attention on the giant rockets, the actual space R&D cost for building Starship was around $3 billion in 2025, which sounds like a lot until you see it completely dwarfed by the staggering $12.7 billion capital expenditure, meaning the upfront physical costs required just to build out the XAI data center hardware and infrastructure. The AI division is basically acting like a massive cash black hole, just pulling in capital at an absolutely unprecedented rate. To really emphasize the sheer scale of these losses, in just the first quarter of 2026 alone, the overall company burned through $4.28 billion. And the primary driver of that insane loss? A massive $7.7 billion spend on the AI side for just those 3 months. So yeah, while Starlink is out there minting billions of dollars, the AI data center build-out is burning through that cash even faster. Now, to offset these massive AI costs, the SEC filing heavily touts this huge deal where competitor Anthropic is leasing SpaceX compute power for $1.25 billion a month. That's a potential $45 billion deal through 2029. But there is a bizarre discrepancy here. Right in the middle of the SEC quiet period, Elon Musk actually posted on X that this is really just a 180-day short lease, capping it at a maximum of $7.5 billion. Think about that. That is a nearly $40 billion difference between the official legal paperwork handed to investors and what the CEO is publicly stating online. Okay, moving on to Section 4, the ultimate controlled company, looking at governance and power. And this brilliantly illustrates exactly what retail investors are walking into. The reality of this governance structure is just staggering. Through Class B super voting shares, which carry 10 votes each, by the way, Elon Musk retains an absolute, unbreakable 85.1% voting power. The public, and literally all other shareholders, just split that remaining tiny fraction. This means when you buy a share, sure, you're along for the ride, but you have virtually zero say in how this company is run. Musk retains complete, unquestionable control over the entire direction of the business. We also have to ground all this massive sci-fi hype, Mars colonies, orbital data centers, in harsh legal reality. As the company states, word for word, directly in its own S1 risk disclosures, many of our initiatives involve significant technical complexity, unproven technologies, or technologies that do not exist and may not achieve commercial viability. Add to that the $29 billion in debt just sitting on their balance sheet, much of it tied to high-interest loans for the XAI build-out, and you really start to see the immense financial risks at play here. Which takes us to Section 5, the mega IPO trap, and some historical context. So the crucial point is this number right here, 94 times. That is the price-to-sales ratio being asked of day one investors at a $1.75 trillion valuation. Let that sink in. You're paying $94 today for every single dollar of revenue the company brings in over an entire year. It is, frankly, one of the most stretched valuations in modern market history. To provide a bit of scale for this massive price tag, let's contrast SpaceX's 94x multiple against an established, highly profitable tech giant like Alphabet or Google, which currently trades at just an 11x price-to-sales multiple. That means SpaceX would essentially need to 10x its current revenue just to reach the valuation multiple that Google commands today. You are paying for a massive, massive amount of future potential before that potential has actually hit the balance sheet. And historically speaking, buying into these hyped mega IPOs on day one, it can be a massive trap. The day one price almost always factors in the most optimistic outcomes literally possible. Take Facebook back in 2012. It quickly dropped below its offering price, trapping retail buyers underwater for over a year. Or look at Uber in 2019. It took 4 long years before day one investors turned a profit. And of course, Coinbase in 2021, which dropped nearly 90% before it eventually recovered. The pattern is pretty clear here. Massive hype often leads to a massive drop when lockup periods expire and early insiders start selling, trapping retail investors in the red for years. Which brings us to our final question. When you look at this upcoming IPO, you really have to weigh 2 conflicting realities. Are you investing in the greatest, most vertically integrated technology empire in human history that will literally reshape our existence? Or are you gambling on a 94x sales multiple for technologies that, by their own legal admission, do not even exist yet? The technological upside here is absolutely unprecedented, but the historical and financial risks, they are severe. Well, thank you so much for joining me for this explainer. I really hope this helps you make an informed decision, and I will catch you in the next one.